Welcome, everybody, to another episode of Scale Your Real Estate Podcast. And this one's going to be another great one to get you closer to that goal of financial freedom, specifically through co-living. This is Pascal. Pascal is an expert on raising capital for deals, big deals, businesses, and then we talk a little bit about his experience in raising capital for co-living deals. In addition to that, he talks a little bit about how he manages his property and how to invest and kind of his mindset on investing from a distance, and how it's really important that you know yourself, you know your skills, you know what you're after, and you double down on those things. Enjoy this episode with Pascal Wagner. You guys are going to love this episode. He's been a dear friend for many years. Enjoy. I want to talk about raising capital, because how I see you is like this guy who, I just see you as anybody, I see you as ahead of the curve for someone your age in the space of raising capital. You've funded a business with capital's money. You've then exited that business. You've done co-living, raising capital, other people's money. And this other people's money thing, man, like this OPM, right? Like it just fascinates me. And I've always been interested and fascinated by how your brain works around it. Because I think for you, and I don't even think you know how your brain works around it. Because me, I'm like, I have to save the money. And you're just like, yeah, I could just ask this guy and he'd give it to me. I'm like, so there's something in your head that's different about how you perceive using other people's money, where us normal people are like, no, man, I'm just going to save it for my day job. How and why do you think that way? How did you get to be like that? And how can we think more like you? And why do you want to use other people's money so often? I know that's a lot of questions at you, but that's actually where I want to start this conversation, because it's just something I'm trying to learn. So selfishly, I want to know, and I think it'll really help the audience as well.
Yeah. So look, I think it all started back when I was in high school. I saw tons of articles on TechCrunch about companies raising $2 million. $2 million seed round. Uber raises X million dollars, and they continue to grow. And so, I think naively when I started, that's what I saw as success. Like people building and raising money to eventually build a unicorn, and having that be the big dream. So ever since, I started reading some of these TechCrunch articles, I started getting into startups. And I did a bunch of different startup weekends and raised, went around, started to raise money, got grant money to continue building product. And I think it was just the environment that I was around where my dreams were so much bigger than what I could do with my own money, because I didn't have any, right? It's like, if you don't have any, then really hard to go out and buy a bunch of property, right?
Right.
And so it's then the next question is, okay, well, can I do this with other people's money? And I think that's when I started to realize and learn about, you need to provide a specific type of return for the amount of risk that the investor is taking. So, I think it's always just been, you can only go so far with your own money. But if you know how to get and use other people's money, provide them a great return for what they're looking for, then what I can do is endless.
Dude, so well said. So this is like one of the perks of like not having money. You get to learn this whole new skill set, right?
Yeah, arguably it's a lot harder though, right? Because very difficult to have someone give you money if you don't have a track record. Whereas in my case, I think about the first time I really raised money for real estate, I had already bought a couple homes and have had built a track record. I think that pretty much goes without saying now. It's, if you're going to go raise money, you need to have a track record of whatever you are doing. In my case, Diego Corzo and I, we just cobbled our money together and started buying a couple homes that we then turned into co-living, right, in order to have them generate a lot of cash flow. And, in that essence, it was like Diego used my money in order to get into the game. And And that's how we started building up our portfolio. And he eventually, bought in as a 50-50 partner into our deals. But that allowed Diego to grow and build the start to his legacy. He needed someone like me or that had money to do that. And so, good on him for finding someone like that. And me, when Diego asked me the first time for money, it was very much, he had very well researched it. He had all the financial model in place. He told me how we could pre-sell the home before we even made an offer to see if the rooms would rent, right? Like it was very strategic. And also I knew Diego was a hustler, so I wanted to partner with him, right? And so I think similarly, if you don't have much money, if people know you as a hustler, or if you have a track record, the track record's better, you're able to go out and start doing deals with other people's money that way.
So let me see if I've got this straight. And I think this is a beautiful lesson for people. It's like, hey, if you're going to go out to the marketplace and just raise from outside investors, like people who don't know you, you're going to need to be able to show a solid track record. And if you don't have a solid track record, but you are a trustworthy person, you could go to family and friends like Diego went to you, because I know you guys have been friends for a long time, and he leveraged you, and he leveraged just the trust he had with you as a buddy, not because he had done a bunch of real estate deals. And you were like, yeah, because I trust you and I know you've done other things well, so I'll give you the money. Is that kind of...
Exactly. That's exactly it.
When you say a good return, just, this is a very like technical question, I guess, maybe to bring it to this, but like, let me tell you why I'm asking this, because I've found people that are like, well, for me to get investors money, I have to give them like 20%. And I'm like, no, you don't. There's money sitting in a savings account. But like, what do you consider like right now? Like, let's just say I was going out and raising money from either friends or family, or maybe a couple close investors. How do I have to structure that deal? What do I have to pay them? What does that look like? What could it look like?
It all depends on who you're asking this question to. If you're going to go and ask this question to Warren Buffett or Ray Dalio, like one of the greats who really knows what to do and how to place money, their answer is going to be totally different. Whereas if you ask your grandfather or something that's not very tech savvy, and he has his money sitting in the bank and he hasn't really done investing before, and he doesn't really understand the risks of what you're doing, then he might say 5 or 8 or 10%, right? And it's, I think it's a little bit of a dance where the investor doesn't really, unsophisticated investors like that don't really know what a good return is. All they know is what they're getting currently from either the stock market, their average over the last couple of years, or what they're earning it from their bank account. And so I think that's why maybe unsophisticated investors kind of hop into these kind of opportunities, because they don't understand the risks, and they actually don't have any other opportunities that are returning a certain amount. So when I think about the first investors that I raised money on for co-living, they were from 4 individuals. I raised a total of $200K. This was back in, 2019. And
you knew these people? They were like friends.
Friends. Yeah. And I made a Facebook post online, and I was like, hey, I'm running an experiment. I have this portfolio of 4 homes. They've been returning this much. I'd like to try out a strategy where I use other people's money to fund the down payment of the homes, and I will pay 8% interest. And I kind of just stuck, a dart out there, and I had a couple people jump. And so, I think it was because over the years, for like as long as I've been an adult, I've been building in public. I've been showing, hey, here's what my returns look like. Hey, I bought this property. Hey, here's, in the last year, here's what my properties returned. And arguably, I haven't done as much of that lately. And this is a good reminder to myself to do more of that, because that's how you build trust with people in your network. And, whereas if I go to go to a sophisticated investor that invests in these syndications and funds, they're investing in institutional quality things, and they understand the risk-adjusted returns, and they understand, when I put money into this fund, I'm 0.5% of all capital that this fund's using, and all the risks are clearly defined. And so trying to raise money from someone like that, who already invests in a bunch of different deals and has access to high institutional quality people, that I would say you're barking up the wrong tree if you're first starting. And so I'd hate to say it, but you're probably, if you're in the beginning phases of this and you haven't done it before, you're probably raising money from non-professional investors.
Yeah, man, that's such a great reminder to, as we're learning, I think, is even like maybe some of my students are even listening to this episode, where it's like, if you're learning, you're doing something, like, it puts a whole new positive spin to using social media to build social proof in you and what you're doing. I mean, that's really, really powerful to use that. People go, okay, I see what they're doing. You share what you're learning. And so I love that. So you mentioned, and that's cool, by the way, I did not know that part of your story where you raised $200K off of a Facebook post. That's pretty badass. I mean, that is really badass, actually, if you think about it. Where that could be the down payment for 3 co-living properties right there, 2, 3, 4 co-living properties, depending on your loan terms. But is there any, and I know you've been studying a lot here recently, the legalities of raising money, and there are a lot of legalities around it. And did you, I think didn't you just pass a test or something for your financial advisor? Nice. Congrats.
Thanks.
What is there any, for someone just starting, is there any illegalities with like throwing a Facebook post up like you did? Like, is that frowned upon? Can anybody do that? Can I just throw a Facebook post out and be like, I want to buy some more co-living homes, if anybody's interested in paying 8%? And I literally have no idea the answer to this question. That's literally why I'm asking you, is I know you've been studying this for the last couple of years, for the last couple of months at least.
Yeah. So I think the answer here is it depends on what kind of structure you're ultimately looking to do. And one, I'm not like an attorney or anything like that. Like, I could totally be wrong. And online, I'm seeing people do stuff illegal all the time, whether they know it or not. So it's happening. From my understanding, how this works is it depends on your offering. If you are going to go put together an official fund, you're raising millions of dollars, you're going to, do a 506. There's different types of funds. You can do 506B, 506C. They, some you can market to accredited investors. Some you can't solicit online at all. You only can go to your network. Then there's JVs or joint ventures, where it's like, hey, Sam, you put in 50 grand and I put in 50 grand, and like, we're going to create an LLC and we're going to go buy a house together. That has totally different rules than all the other ones, because you're in that instance, we're partnering and we're both partners in the deal. And so you're not buying a security at that point. We're forming a company. It's different concepts. And so the rules and regulations around that are totally different. I don't actually know the rules or law around, what you are allowed to say when it comes to joint ventures.
But basically, that's like a partnership. You and me are just buying a house together kind of thing.
Yeah. I mean, if I just went online, I was like, hey, I'm looking to raise some money to put into this deal. I don't know what I'm going to offer yet, probably somewhere between 8 and 10%. Who knows if that's legal or not? I don't know. I kind of went and did it. That's something I wrestle with when I go through this space, because, the repercussions for if you're going to go raise a fund and you do it illegally is jail time. And there are a lot of people that I'm seeing online that are raising money that, the SEC is starting to button down on a lot of these things, because there's been such a huge growth spurt in the investing into the syndication world that I think people are slowly going to get knocked off their chair here in the next year or two. But
just to say, like, if you give me like you did, you posted something on Facebook and you come and you give me some money and I write you a promissory note, which is just a very basic document that says, it's basically a personal loan, same as if you gave me like 10 grand to buy a car.
Totally.
Because I didn't have
how I structured my deals.
Right. And that's a very simple, easy way to structure the deals, right? Like, I'm paying you back over, I think did you structure yours over, was it over 5 years?
7 years.
7 years. Oh, wow. So that's great. I didn't know that. Okay. So yeah. So 7 years, and you're paying them interest only for 7 years, and then you pay them off in the principal.
I was paying them principal along the way.
Principal along the way.
It was a straight line interest instead of like a true mortgage,
Got it. So technically it should be okay. I've always heard that it's okay. And obviously if you're doing like the bigger volume you're going to do, the more it could get looked into by the SEC, right? But like, if it's a promissory loan, there is no technical rules against how much money someone could loan me if I just ask you and you give it to me.
Totally.
But be careful is what I hear you saying.
Look, I think with all these things, right? Like, did I go get an attorney to put together a promissory note? Yeah. Did they advise me on how I marketed the trend, like to get people to loan me money? They didn't do that. So, in retrospect, do I know if that's legal or not? I don't know.
Got it. So check with your attorney to be sure,
right?
To be doubly sure. But yeah, okay. So we're not in here like talking like lawyers. It's probably It is totally fine for you to raise as much money as you want.
Yeah, but to be fair, selling a loan. I mean, I guess selling a loan is in theory a security. So I imagine there's some rules around that, but I think it's, if you're raising 50, 100 grand. Very different play than if you're putting together a fund. So, right.
And Pascal, I've done the same thing. I've just gone to, which I think is a really simple, easy way to do it. You can just go to friends and family, say, hey, I'm doing this deal and I need some capital for this. And my brother's given me 100 grand before. It's just a very simple 1-page document. And obviously, like you said, it's so important that you're building off of this either a track record, or B, just, trust. And then, of course, like C, I think it goes without saying, but like, be a good person, pay your investors back, pay them on time. Like, this is like, know what you're getting into and understand that you've got to take care of your investors. Because if you don't pay your investors, word will get out super fast that you ain't the best person to loan money to.
Yeah, I mean, something to highlight here is that your reputation when you borrow other people's money is probably the most valuable thing that you have in this deal. Like, the amount of money that you're going to make on one of your first deals is inconsequential to what how much money you could make if you continue to do a good job and return capital to your investors. So, I think something that's being highlighted here right now is that, there are a lot of deals in the multifamily space that are blowing up, and GPs or partners in the deal, the people who are running the deals, are still taking, some of their splits, and even though investors might be losing money in some cases, right? And the likelihood of you being able to raise additional money in the future is really low. Like, imagine this, like, you had a deal go south, you lost, 20% of your investors' money. Like, didn't go up in flames, didn't lose all of it, but like, shit went sideways. And now not only are those investors going to be sour and like probably not invest with you again, but also any deal you go do moving forward, if someone does their research on you and they ask you like, hey, have you raised money before? And if you say no, right, flag 1, because you're lying, or 2, if you say yes, and they ask what happened, and it's like, oh, we lost our investors' money, and they ask, okay, like, what'd you do about it? Like, you now have a track record of not providing their investors their capital back plus their return. So it's just something, when I raise money, I don't take it lightly, and I think, it's so, and believe me, I was there, right? Like, I've been scaling my portfolio. I now have 12 homes, and I've gone through this where I'm starting to raise money, and on the one hand, you want things to be this rosy picture, like, oh yeah, we're totally going to make this much in cash on cash a month. But it's the moment that I started raising money, I was more careful and more conservative in all of my underwriting, because I would have someone to answer to when things go sideways.
Yeah, man. Thanks for highlighting that point. It's like follow through. Don't get too optimistic. There's a benefit to really, 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 really being careful. I love that you highlighted that. Thank you. I want to transition a little bit to just talking about co-living. We've like mentioned a little bit, but this podcast was originally started for kind of this co-living niche. So I know you and I have gone back and forth in this a little bit. And one of the things I admire about you, man, and that I actually I don't know if you know this or not, but every 5-day challenge I do, I mention you. I've got a whole slide with your picture on it.
Oh yeah, I love that.
And I bring you up, and one of the points I make about you is that you have invested from a distance. And so I want to talk a little bit about what made you. So you live currently in Denver. I know you're thinking about moving to Miami, which is awesome. But what allowed you why did you decide to do all your co-living homes in Atlanta? Maybe I'll start there.
When I started investing at all, I always tried to align myself with someone who would primarily be the feet on the ground, the person handling the deal. I tried to position myself as being the money person. And so as long as the deal made sense and I trusted the operator, it didn't matter where the deal was. Because from the onset, my goal was never to be an operator in the deal, ever. It was just like the mindset I had going in. And so if I had to be a part of the deal, it wouldn't pencil. It would be a no-go. So people would start to bring opportunities my way, like Diego, and we started investing in Austin. And why did we start investing in Austin at first? Well, it's because Diego lived in Austin, and that's where the deal was. And so, cool. That's where we bought our first home. That's where we bought our first 4 homes. And then, I met you in GoBundance, and we became friends. And I flew out and hung out with you, and you introduced me to Jason Wallace, who I ended up doing the same thing. He was the boots on the ground, and he was the one managing the properties, and I was more of the money guy. And so now I had properties in Austin and properties in Charlotte, and all because of that mindset of I don't want to be in the deal. And then I finally got to a point where, I'd always struggled to find. I had the issue where I always had to partner on deals. So I always had to be a 50-50 partner. And I wanted to have more of the ownership and ideally pay someone a property management fee. Much easier or much more profitable for me to pay a property manager 15 or 20% and then own the whole deal than for me to split the deal. And so it took several years. The space is very new. And finally, I came around and started learning about Pad Split. And Pad Split is a property management company that focuses and specializes on co-living. They're like the Airbnb for co-living. And so their main hub was out of Atlanta. And I basically said, look, I have homes in Austin and I have homes in Charlotte. And, technically I have 2 different managers and they're in 2 different states and they have different laws and different taxes, and there's a lot. Once you start building up a portfolio, it's very hard to build systems when not that many things are in common. And so to me, then the next step was, okay, cool. I found a new partner that I can now pay a property management fee and own the whole deal. So let me focus on consolidating that portfolio. So I went and, got sold the other properties that I had, and then built everything up in Atlanta so that I had that partnership there, and I only had to talk to one person, deal with one set of laws, deal with one set of taxes, that whole gamut. One property manager, one agent, one insurance, all the things you need in real estate. Now, anytime, that I need. If I want to go buy a new home now, I have the contractor, I have the property management. Like, I just say, hey, let's flip the switch on, and the machine works.
Yeah, man. So much good stuff there. You know your strengths. I think that's an important lesson for listeners to take away, is like, you've really identified, I'm the money guy and I want to be the money guy, and I don't want to be the boots on the ground guy. And so I have to find boots on the ground guys and girls, people that I can trust. And I think I was just quoting this to someone the other day. Know thyself. It was actually in that post for Dustin. I was like, know thyself. It's like such an important piece. And I think I bought one of those properties from you in Charlotte. Didn't I? Viola Lane was yours? Yeah. That's great, man. That property's doing good when you sold out and went to Atlanta. So I want to ask you about pad split, but before I go into pad split, I had another question I was going to ask you that was really important. It just skipped my mind. So you pick, economies of scale. I wanted to make a comment about that. So economies of scale, you're in one city, and co-living, I'm curious if you agree with this or not. Co-living is new enough where like if you were going to buy quadplexes, like, who cares if you have one in Denver? There's a million property managers in Denver that'll manage a quadplex. There's a bunch there's hundreds and hundreds. I mean, millions is an exaggeration, but there's hundreds and hundreds in Charlotte. There's hundreds and hundreds in Denver. There's hundreds and hundreds. So like, if I'm going to buy a quadplex, like it's okay to like invest in different cities. Like, is that still ideal? I don't know. But in my mind, it's easier. But with co-living too, I think especially at this stage, you can't just go anywhere and get someone to manage it. Like, you have to have somebody that kind of proprietarily manages co-living. Have you found that to be true, at least at this stage of this investment cycle?
If someone doesn't know if you're trying to get a normal property management company to manage a pad split property, I just imagine it being a nightmare.
I've seen it be a nightmare personally. Yeah.
Yeah. Like, I actually went around the country and interviewed different property management companies and asking them, hey, would you do this? Well, because I had that problem where I kept splitting the equity with different partners. And it's not like I didn't gladly do that, right? Like, they did the work that, but I had an incentive to pay the partner instead of split the equity. And so, yeah, I was calling around. I spoke, I think, with like 17 different property management companies.
Nice.
And it, at that point I was just like, fuck,
what did they say?
They have think about it. Like, these property management companies are used to filling a home with one tenant and putting them on a 12-month lease, and don't have to deal with roommates or clogged toilets or trash or fights or someone stealing my food. Like, they don't have to deal with any of that, right? And so for you to come in, and they might have 500 properties under management or even 100 or something, and then you're the odd house in their portfolio that now has 6 or 8 tenants in a home, and I mean, they'll just kick you out. It's like, it's like they'll fire you as a customer. It's just, it doesn't fit their model. It doesn't make sense for them to. And to me, it was like, if they have no concept of what they're about to get into either, right? Like, they're like, oh yeah, totally, we'll do this. And I was like, okay, actually, like, reading between the lines, I'm realizing this is not a smart idea. And even just with 2 markets of Austin and Atlanta, for me, it's just, if I can find properties in either city, why would I diversify into other cities? Because I can't build process and procedures. I have to have now 2 meetings, like one with Atlanta, one with Charlotte property manager, and one with Austin property manager. Now it's 2 meetings instead of 1. And, at the beginning, I started that way because that's where the opportunities showed up. And I didn't know any better. And I also didn't have a strict buy box. It was like, yeah, I want to do co-living and it needs to have these returns. It wasn't part of my buy box to say, hey, I only want to focus in one geographic area because I know it'll streamline all my systems and SOPs, and I just need to be more patient to find another deal in my city. I didn't have that experience to know that, but now I do.
So many benefits to buying, scaling in one area. You've talked about, I know you're using pad split right now, but you've even talked about getting to a certain scale and starting your own property management company. Like, obviously that even in of itself would be so much more difficult if you're in 2 or 3 different cities, but at least you're in one city, you have options, right? You just have a lot of options. So you, a while back, did an experiment with Homeroom. I don't know what happened with that experiment, but I do want to talk a little bit about pad split, just your experience with them. I get this question a lot. And obviously we both know a lot of high ups there, and Atticus, the CEO, is a good friend of both of ours. And so just curious, hey, maybe you talk about the pros, maybe talk about the cons. And then I'd love for you to talk a little bit about the pros and the cons of Homeroom. That's an up and coming company too, that I know you tried. And I'm starting to hear that name more kind of out in the community. Oh, they'll help manage your property and go from there. So curious your experience there.
I think you need to figure out what game you're playing, right? And for me, like you said, I focused on being the money guy. And so my big focus was how do I hand off the whole portfolio? I now have a once a month check-in, and we review metrics and, where are we at with the homes? What happened? Why? What preventative things do we need to do? What happened? Like, a sewer line broke, and and so a room flooded, and it cost $3,000 to fix, and just talking through all the scenarios that happened. Pad Split is an interesting, kind of all of these services are interesting. They play in different ways. Pad Split, if you're going to self-manage properties, I think you need to figure out, like, if you're still going to the properties, being the maintenance person, or you're the person in charge of calling the maintenance person, or, still dealing with issues on site, that's like one form of, the work that you need to do in order to earn the return from the homes. And with Pad Split, they've kind of divided theirs up into two parts. The first is the marketing and the filling of the homes with the tenants. And so arguably what I'd say is, if you're using Pad Split, you're basically saying, hey, I'm either not good at marketing, or I'm not ready to take marketing on yet. And but I still want to manage the properties myself, because then if you're going to do that strategy, what I would do is focus on how do I build SOPs and make that as streamlined as possible, and make it run smoothly, so that the next thing I do is take on the property, like filling the homes with the tenants. Or you could just say, hey, that's not what I'm interested in.
Yeah, I don't want to do that.
I don't want to do that, right? Like you, for example, if I still understand it correctly, is you are vertically integrated. You do the marketing, you get the people in there, you have someone in-house that manages it, the whole nine. And you get a lot more of the return for that. So I'm paying close to 23% in property management fees, but for that, I am 100% hands off. If you go with Pad Split, you're like 50% hands off, right? You have the them filling your homes, and then you needing to do whatever needs to be done on site.
Right. So they manage the tenants, just so people understand. They manage the tenants. They're going to take care of tenant complaints, filling them, signing those leases, making sure you get your money, collecting. But if a toilet breaks, Pad Split's not going to take care of that. You do need a separate property management company. That's right. Is that how I understand? That's how I understand it.
Right. Okay. And so I'd be interested in hearing Atticus' take on this, but I'm wondering if their target avatar of an investor is someone who doesn't want to deal with the marketing, but wants to do their own property management. That's how I know, at least the investors that I know that do Pad Split, that's how they use it. And to me, it's like,
you're looking for more of a full force solution,
right? And look, I think if it is an interesting thought process, right? Like if I said, hey, I've decided that I want to bring property management in-house, I would probably do it in stages. I'd probably say, cool, let me just do all of the maintenance stuff and get all of that taken care of, build SOPs, make that run smoothly, and then I take on the marketing, so that I'm not doing everything all at once. Like that could be an interesting, unique way to do it. But I think you need to decide where you want to play. Like the reason why I don't like doing the on-site property management is because I think that it takes up mind space, and I could go make more money buying more deals or raising money.
This is full circle to kind of what you've kind of a theme that I didn't think was going to be a theme of this podcast, but it is, which is like, know your strengths. You said it a different way. I think you said just know what game you're playing, and then double down on that. And you're just like, no, that's not me. And I think investors would do well to do that. I think maybe in the beginning, you kind of have to be a generalist. If you're at your first home, you're kind of a generalist. You're trying to do a little bit of everything. But there comes a point, and for me, that's like 5-6 homes where you got to kind of like, hey, if you're managing, I mean, I'm talking specifically the co-living world. If you're managing 5-6 homes, you're 30, 35 tenants, 40 tenants, like that is a job to somebody, either you or somebody else that you're overseeing. And so 5-6 homes in my mind is where it really becomes that business, and you need to make that decision if you're trying to get to financial freedom and you don't have a ton of wealth already, of, hey, do I pass it off or do I keep it in house? But you also experimented with this other company that's kind of branded themselves a little bit differently than Pad Split, Homeroom. And are they the same way? Did they split it up with like, we manage the tenant and then you hire somebody else to manage the property, or are they a full service?
So they were a full service.
Okay.
They were like 15% all in for everything.
So cheaper by 8%. It's pretty significant.
Pretty significant. Worth trying.
Yeah.
We just ended our engagement maybe 2-3 months ago, and I moved my last property back over to Pad Split. I ran that as an experiment for 9 months, and it initially the rooms filled, and then the rooms just began to sit vacant, and I sat down and came to a meeting and was like, hey guys, like, what's happening here? And I was like, okay, what's your game plan for filling it? And they didn't have one. And that was a little disappointing. But I think one of the learnings is that, my type of home, it didn't have a common area. It was a little bit out of the buy box that Homeroom looks for when they look for investors to partner with. And I was outside of that buy box. And so at least what, I can't confirm, but what they've told me is, they don't have problems filling any of their other homes. But my home's a little bit different. It's got more rooms. It doesn't have a living room, whatever. And so it ended up not working. And, I think another good lesson in, like, we all need to stay within our buy box for these things to work.
Yeah. So what advice would you give somebody who's looking to get into the space of co-living? They're faced with these different options. How would you advise somebody? What advice would you have to someone who's trying to sift through this and make decisions about whether they want to self-manage or go with the Homeroom or go with Pad Split? I mean, how would you advise someone in that situation?
So the first question is always, what's the end goal? Is the end goal to not be tied to your job? Is the true goal financial freedom? And what does financial freedom mean? Because financial freedom to me means I'm not doing anything. To a lot of people, they might, when they're getting into buying real estate, managing real estate, I believe, is another job that's just different than your W-2, but it's a job that you can control. That is a level of financial freedom. And so first deciding where is it you want to go? Hey, I want to get to, for me, when I started, it was, I want to get to $3,500 in net passive income a month. And it's okay if I need to help self-manage that, but that was my initial goal. And that's where Diego and I got to. We had 4 homes. We were in Austin. We both made $3,500 a month net. We managed it all. We
4 homes. Let's go. That's $7,000.
So he was doing the on-site management, and my role was I would be getting applications for tenants, reviewing them, doing initial calls, managing the finances, making sure I do the bookkeeping. That was my role, and so I was okay with that. And I think you need to go in with the idea of what is in my buy box and what is not. For me, at the beginning, it was okay. Now, my dynamics have changed. I'm further along in my career. I have a little bit more money. And so to me now, that financial freedom bar has raised. And it's like, I just want to do a once a month call with my property management company and check in. And like, maybe I need to change property management companies or, do some slight things. But generally, I'm not the one day-to-day managing it. So yeah, man, I think
those are solid questions, dude.
Starting with the end in mind, understanding what your buy box is, what am I willing to do and am I not willing to do, and stick to the plan, right? Otherwise, you'll be unhappy.
And just to kind of, this is maybe one of our final questions before I just find out, you give some information where people can reach out to you and find out more about you. But like, you have been you said stick with the plan. You've been very perseverant. I don't even know if that's the right word. You've demonstrated a lot of perseverance in your life. And it's something I really appreciate about you. I mean, you went through your first business, you raised, $1 million+ for that. I think $1.5 million for it. It didn't turn out exactly as you wanted, but you did. You paid your investors back. And then you went to the co-living thing, and now you're shifting again. I mean, you've really, really shifted. What is your secret to continuing to shift to find the thing that fits you, and kind of persevering through some of those what people may perceive as failures? But I've never heard you even use that word. It's always like, well, here's all the things I've learned, and I'm taking that with me into the next thing. How do you, there's just so many people out there that have either tried to invest in the past, or I know for me, it was like, I just heard it from my dad. My dad was just like, I bought a bunch of real estate and it ruined me. And Sam, you're my retirement. Like, figure out the money thing, And so how would you advise someone, or what thoughts would you give them on that, as far as just being able to develop that same kind of muscle that I've really seen you develop in your life?
This is a good reminder to self. I tell myself this pretty often, especially when I get punched in the face, metaphorically, which is there is no other option, period. It's like,
wow,
okay, I failed, quote unquote, failed at this. Okay. If I go and what are my options? Either say, hey, I'm not going to go pursue my former dream anymore, and I'm going to be stuck making minimum wage, and I'm just going to live this life, and I accept that, or I just keep trying. It's like the other option is not great. It's like not even an option. It's like, that's not the life that is worth living for me. And so, I mean, it's like, yeah, I mean, I'm even going through this right now, right? Like, I'm starting to raise my my next fund, and I'm now back at square one. I'm starting something new, and so it's okay. Well, if I don't do this, what would happen next? Like, my life only goes downhill if I don't choose to move forward on this path. So yeah, I mean, there really just is no other option for me.
Damn, bro. You're ending with Sam on Goosebumps. That was good. I was like, but it's true, man. It's like, what are you going to do? Give up on your,
how do you think about that?
Don't give up on your dreams. How do I think about it? I think about quitting every day.
I mean, don't we all? We all do, right? Like,
that's how I think about it. I'm like, I don't know. Do I really want this life? But man, I mean, how I think about it is, I'm the type of guy who kind of has to be continually reminded. You and I both achieved, we're not at this place in our life where we're like generations beyond us are necessarily going to be wealthy, but we're at a place in our lives where like we're good. And that can be a little too comfortable, and it can seduce you to thinking like, do I really need like the next level and this? But you brought up such an amazing point. It only goes downhill. There is no such thing as let me stay here for a while. It's no, you don't work out this week, you got a little weaker. You don't work out this month, you got a little more weaker. Like, so surrounding myself with guys like freaking you who are just like, I'm pushing hard too. And I don't have to necessarily, but I understand what happens if I don't push hard. I first get comfortable, and then I get a little weaker. And then I go, and then like ultimately it leads to you giving up on your dreams.
Dude, I have the same concept with gaining weight. I am building my physique, and I'm on track I started at 145 pounds in 2018.
Soaking wet at 145.
Yeah. And now I'm at 178. My target this year is to weigh 180 pounds for 5 consecutive days. I eventually want to get to 190 and slim down, but I've been going to the gym and training and working on my physique for the last decade. But it wasn't until, my dad passed away in 2021 when I had this shock and this, like, what the fuck am I doing? Like, I can't ignore, I was frail, not frail, but like I looked not great. I was skinny and didn't have any muscle on me. And at some point you just understand that, like, you can ignore it all you want, but that doesn't change the game.
Wow, dude, it's beautiful. That's beautiful. Thank you for that. I think that's an appropriate place to kind of wrap this up and just inspire people to go pursue your dreams. We have this beautiful life. Let's go make something amazing out of it. And man, I think doing it with cool people like you really helps me. I need these conversations. Dude, it's so funny.
One second, I'm gonna cut you off. I still have, like, for all those, Sam gave me this gift.
I love it.
It said, "Thank you for being such a positive influence on me in 2015. I'm truly a better person because of it. I look forward to building our relationship even stronger in the years to come. Merry Christmas and Happy New Year, Sam Wegert." And I keep
8 years ago,
and I'm reminded about this every time I look.
It's awesome.
So surrounding yourself with people like this is, it makes it all fun and worth it, right?
Yeah, I was telling someone the other day that I was starting a podcast. We haven't even fully launched yet. Like, we got a bunch of great episodes. You're going to be around some badass people, man, too, and you're right there in with them. So I'm excited. But I was telling them, I was like, I love starting a podcast. They're like, "Oh, how's it going?" I was like, honestly, the episodes aren't even for anybody else but me. Like, I learned so much. Like, it's all I get to ask awesome people like you all the selfish questions I want to know, and like I get these reminders and I get goosebumps, and I've cried before and had like pages of notes. It's just like me chatting with you is like great. So thanks for your inspiration, man. If people do want to connect with you or invest in your fund, how do they do that? What's the best way for them to connect?
Yeah, you can just go to pascalwagner.com. It'll take you to my link tree. You can find me on all the socials, email me, see all my podcasts, funds, everything like that.
And Pascal is truly a giver. He lives up to that in so many ways. We were in Miami the other day with you, and you talked with my friends for like, dude, I think it was like 4 or 5 hours, and just they came back like, that guy is amazing. He gave us so much value, and I learned this from him, and I learned this, and I learned how to do this, and I was like, I was like, that's awesome. You guys learned all that. So thank you for being a giver and for who you are, man. I just appreciate you so much.
Yeah, no, thanks. Thank you for the invitation here, and I always love spending time with you. Thanks, Sam.